Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. So, what a day. What a day for gold and silver. A very significant day, I think. And the move that we got in silver today, a pretty decent move, up over 2%. If you watched yesterday's video, you know we were forecasting a potential breakout in the price of silver and the price of gold following a weaker than expected CPI data. And that is exactly what we got this morning. You can see here on this chart that there was a sharp uptick in the price of silver on the release of the data, almost got up over 32 bucks. Now, this move in and of itself is not the biggest move that we've seen in the precious metals. Certainly silver's a volatile market. It can move a lot in one day, and a 2% move is not the biggest move possible, but when we look at the charts and we examine what's going on with these markets, I think you'll find that the move in silver today is more important than just that 2%. And it has to do with why silver moved on the release of this data, what's coming next for the Federal Reserve, and what's coming next for the economy, because it's looking like things are about to get ugly. We're almost into crisis territory. We're going to go over some data in this video that supports that. And let's just talk about the inflation data first, getting started. This is what kicked off this move in the price of gold and silver. And I see some familiar faces in the chat there. Welcome to the live stream. Do me a favor, if you're joining, if you're watching this later, smash that like button. Consider subscribing to the channel because you're not going to want to miss the videos over the coming weeks and months. This is about to get pretty interesting, I think. But what we got here was a 3% year-over-year increase in the CPI. That was against an anticipated increase of 3.1% and compared to a 3.3% from last month, so a cooling in inflation, according to the official numbers. Now, keep in mind, these numbers are not necessarily representative of the reality on the ground, and it is possible that, they just release whatever CPI numbers are convenient for them because they can massage the data, but if that's the case, it's interesting because it seems like whoever's cooking these numbers up wants it to appear that inflation is cooling. Now, why is that the case? Well, all has to do with the Federal Reserve and rate cuts. Also, the core CPI, that's less food and energy, rose 3.3%. That's against expectations of 3.4%. Also cooler, and it was notably the smallest 12-month increase in the index since April of 2021. So the whole narrative here is that inflation is cooling. Now you combine that with the comments that we got from Jerome Powell just yesterday during congressional testimony. He said that the Fed now will not wait to cut interest rates until the inflation rate hits 2%. He's not going to wait for inflation to return to the Fed 2% target. Now, he says it's because you don't want to overshoot it, right? You don't want to wait until inflation gets to 2%, then start cutting because inflation might fall below 2%, which according to, the central bankers, Jerome Powell, that would be a real disaster, right? I don't know about you. I'd be okay if prices fell a little bit. We got down to like maybe an average 2%, but that's not the name of the game here. The name of the game is debasing the currency, printing easy money, and goosing this economy, which is nearing a financial crisis. Someone in the chat says, it sounds like I'm taking a drink of water or something like every 10 seconds. Well, you might hear me swallowing occasionally. Sorry if you hear me gargling on my own secretions here. I've had some sinus issues following COVID. It's not really anything I'm sure any of you want to hear about, but if you notice that, that's what's going on. So sorry about that. You'll just have to put up with it as I do. Now, let's move on to the CME Group FedWatch tool here, which is giving us an indication of where markets are anticipating interest rates are going to be moving forward. So this is when will the Fed cut rates? Basically, you can see we have an FOMC meeting coming up on July 31st, and the propensity or probability of a rate cut at that meeting is still very low, 8.8%, although it did rise on the release of this data from 5.2%. That was the percentage yesterday. But when we go to September, the probability of a rate cut rose from 69% all the way up to 84.6%. So the point here is that Now inflation is cooling. That's going to give the Fed cover to cut rates sooner, perhaps than would otherwise be anticipated. And again, we did just hear from Jerome Powell that he's not going to wait to cut. Now, why did he, say that right before we get this weak CPI data? Well, it's because they really need to cut. And when they do, it's going to have a major impact on all commodities, especially gold, silver, but basically the price of everything is going to go up. Now, take a moment here to say thank you to today's video sponsor, SD Bullion. If you're a new stacker, if you're considering getting into the gold and silver market, make sure you check out sdbullion.com/new. They have an offer over there for new customers. You can get gold or silver at spot. So let's take a look at the chart of silver. Now, again, this kind of puts today's move into more context. We are in the midst of a significant uptrend in the price of silver. In fact, let's go back to Google real quick because this kind of shows you just how big of an uptrend we're really in. Silver up 2% today, month over month up 8.3%. Year to date, silver up 32.2%. And of course, you go back 5 years, silver up 107%. So we are in a significant uptrend. Yeah, it's been a rocky road. I mean, silver is a very volatile asset. But think about this. The silver price is at pretty much the highest level it's been in the past 5 years. If you've been stacking at all over the past 5 years, with the exception of, someone who stacked at the end of May when silver was over $32, you're in the green. So, this is a good situation to be in for stackers, but it's not a bad time to be getting into the market either, because we are, I think, soon going to be headed to new all-time highs in the price of silver. And, this is kind of confirmed when you look at the price of gold, which is at all-time highs, basically. I mean, we're very, very close following the rally today in taking out the all-time high in the price of gold, which is represented by this line. The daily close, highest on record, was back on May 20th, around 24.25. This blue line, we actually touched it today. Now, we've tested it 3 times, right? Here, and just one more time. When this resistance at 2,400 gives way, gold, I think, is going to break out to new all-time highs probably before silver does. Thus far in this market, what we have seen is that gold is leading silver with these major breakouts. We got a big breakout in gold. I'm going to zoom out a little bit here around this level, which it had been testing for years. Around the 2100 level, we broke out of that. That preceded silver's big breakout that we've had more recently. So gold may be leading the charge here. Again, it's right up next to all-time highs. I wouldn't be surprised if we break through that in the next few trading sessions. Once we do, it's going to be a sharp move up. That's just my forecast, of course. This isn't financial advice, but I think when you take a look at what's going on with the global economy, we're going to get into in just a moment here some of the signs that more easy money is right around the corner. Interestingly, also, I know this is trigger warning, careful. UPMA, this is the place where you can earn interest on your Goldbacks. If you're familiar with these, I did a video on this, I think a week or two ago, about how you can actually earn interest on your Goldbacks. The Goldbacks, almost up to $5. That's pretty incredible. It's a 1/1000th out of gold note, and the price of these basically runs about double the spot price of gold, but it moves right up along with it. So those are going to be hitting $5 for a single note. It really shows you just how much purchasing power the dollar has lost, but they're probably going to lose a lot more. So I want to start with this one from Zero Hedge about the Pepsi CEO. So Pepsi's earnings came out today. They actually had a slight beat on their earnings, but they reported weaker than expected revenue growth in the second quarter. So we've seen a lot of these consumer stocks coming under pressure lately, these consumer companies. We've seen Walgreens plummeting. We've seen Nike taking a big hit. Many of these consumer-oriented businesses are starting to feel the pressure. On a call, the CEO of PepsiCo said that customers across all income brackets are reducing snack spend and they're trading down to store brands. So they're getting away from the more expensive name brand stuff, and they are trading in, going in for the cheaper stuff because they're feeling the pinch here. So he also said in the U.S. there is clearly a consumer that is more challenged. And this is a chart from Bloomberg, which kind of corroborates that. This shows that now all of the savings from the pandemic and the stimulus that Americans had saved up, we had excess savings in this country of $2.1 trillion back in 2021. It's all gone now as of March this year. Consumers are back below where they started when the massive stimulus was released, when all the cash was handed out. That's done, right? We also know that credit cards are at a record high, even as the rates on credit cards also head to records. We also have delinquency on consumer debt rising. According to recent data from the Federal Reserve, credit card delinquencies, as we covered in yesterday's live stream, there was that analysis from Wallet Hub. Some cities have seen an 80% increase year over year in credit card delinquencies. So you can see that we're reaching the end of the effects of the previous round of stimulus. Another round is in order, and I suspect that we might get a financial crisis, perhaps even before the stimulus comes, before the rate cuts come. That would mean that we're probably going to get one in short order, because I think that while the declining inflation is sort of cover for the Fed, they might need even something a bit more. But there are signs that, crises are in the works. And then, of course, the real reason, the big reason that the Federal Reserve just has to cut the rates is because of the massive debt crisis that is looming its head around the world. This is a headline from CNN. I mean, CNN of all places. The world is sitting on a $91 trillion debt problem. Quote, hard choices are coming. Now, when CNN is running a headline like this, that the debt crisis has kind of jumped the shark, right? It's reaching ahead. Now, let me ask you this. We're going to get into a few. Thank you, Christopher McCormick, for the super chat. Listen, do you think that politicians are going to make the hard choices necessary to deal with $91 trillion of debt? I don't think they will. But we'll talk about that here in just a moment. So according to this article, governments around the world owe $91 trillion. It's an amount equal to the size of the global economy, and one that will ultimately exact a heavy toll on their populations. Okay, so far so good. That sounds right. And when you have that much debt, it becomes very expensive to service it when rates are high. CNN here also goes on to say that politicians are largely ignoring the problem, are unwilling to level with voters about the tax increases and spending cuts needed to tackle the deluge of borrowing. And, this is not going to change. There is no politically viable way to deal with this. And just do me a favor, in the chat, put a 2 if you think that the politicians will level with their populations and just, impose austerity, ratchet up interest rates, allow a recession, and raise taxes. Or if you think, like I do, that they are simply going to pay for all of the debt and all of the deficit spending through the hidden tax of inflation. Put a 3 if you think that's the case. Because this debt crisis, the only way that it's going to get paid off, $91 trillion in debt, is with devalued currency. History tells us that is how governments will deal with onerous debt burdens. One of the managers, the global head of rates at Vanguard, Roger Hallam, he said this, they quoted him in this article: continuing deficits and a rising debt burden have now become more of a medium-term concern versus a long-term concern, which is how it's always presented. They always tell us, this is going to be a real problem by 2050 or some, far-off number like that. And it deals with human psychology, right? If you tell people that, the debt is going to become a massive crisis within the next year or two, people are going to panic and they're going to freak out. But if you tell them, well, you just have to wait, 50 years or 25 years and, then it's going to be a crisis, well, then people just ignore it. It's just how it goes. Something 25 years down the road, you don't even know if you're going to be around for that. So you're not going to be worried about it. But if you realize that, we're on the verge of a massive debt implosion that could completely eviscerate the financial system, well, that's going to stress people out. And they don't really like to do that. They like to kick the can down the road as long as possible, because part of this whole system is it's a confidence game. If confidence in the system is lost, then the crisis will be here that much faster. So the name of the game is just to kick the can down the road. That's exactly what we've been doing for years. That's why the U.S. alone has $34.9 trillion in debt, not to mention $217 trillion in unfunded liabilities. That's money that we're on the hook to pay. We can't even pay the debt, right? But think about this. This is why the Fed needs to cut. You've got $34.9 trillion or $34.896 trillion in debt. Now, this is from Statista, the most recent data from May. This is the average interest on U.S. debt instruments. So right now, I'm going to pull a calculator up. It sits at 3.27%, and this number is rising, you'll notice. It's going to continue rising for the foreseeable future. We'll talk about that in just a moment. But so you got $34.896 trillion. That's $1.14 trillion in interest every year. That's bigger than the entire defense budget of the U.S. by a pretty good margin. It's catching up to Social Security and Medicare as the biggest item on the national budget. The interest cost, that's the direction it's headed. Federal Reserve needs to intervene in these debt markets to avoid that from becoming the case. Now, these rates, these are going to continue moving up. The reason being 3.27%, that's the average rate on U.S. debt instruments, but look at the current yields. I mean, a 3-month Treasury note is 5.34%. With our kind of weird inverted yield curve, you've got a 5-year at the lowest interest yield over 4%, 4.14%. Now, this year alone, there's over $8 trillion of debt that is being rolled over. That's old debt. That's not new debt. That's just existing debt because, when the government has, say, a 5-year Treasury note that matures, they don't pay it off. We're not paying off our debt. We're accruing more. We're running deficits. So what they do is they just borrow the money to pay off the existing note plus any interest, and it just gets rolled over at the newer, higher interest rate. Now, right now, if they're rolling over, 3-month bonds or 6-month bonds, and a lot of the notes are of those shorter durations, that's not going to cause the yield to go up. But when you have a 30-year note or a 20-year note or a 10-year note, and the average yield on all those old debt notes is somewhere around half of where yields are right now. So when the older, lower interest debt rolls over, gets rolled over at a significantly higher interest rate. So not only is the debt exploding, but the yield on the debt is rising every single month. And the only way the Federal Reserve can really fix this, it's not just going to be cutting rates, it's going to be getting actively into the debt market, buying up these bonds to lower the yield. And that way, the fresh debt and the rolling over of the debt, we can start getting the interest rate down on the debt. And, the elites, the political elites like Janet Yellen, for example, they repeatedly tell us we don't have to worry about the debt. We just have to worry about our cost to service it. And that's going to get a lot higher. In fact, it's going to get a lot higher even than this tells you, unless the Fed intervenes. Look at this chart. This is from a recent report from the Congressional Research Office titled Foreign Holdings of Federal Debt. And this chart, this orange bar here that you see peaked in 2008, this is the percentage of the U.S. debt that is held by foreign holders. So you can see in absolute terms, the amount has actually increased that foreign buyers are holding, although that's starting to change with places like China beginning to dump their U.S. Treasury holdings. But as a percentage of the total debt, it has been declining significantly. Now, why is that a problem? Well, you can see that as the foreign holding declines, the domestic holdings increase. And domestic holdings, if you want to sell your bonds to, mom and pop corporations, small investors like you and me, domestically in the U.S., when you have a major inflation problem, which we have, the yields need to continue moving higher to compensate for the higher inflation and to attract investors. And that's exactly why we have seen the yields rising so much. It's a combination of the Federal Reserve selling off bonds off of their portfolio through quantitative tightening, combination of foreign holders such as China dumping billions of dollars worth of debt, and also the demand for higher rates due to rising inflation, which is likely not going to be alleviated anytime soon, especially if the Fed starts cutting rates. That's going to mean inflation is going to be heading back higher. So the only way to be able to get the yield down is to directly intervene through quantitative easing. And that's exactly what we're going to get the next financial crisis that rears its head. Also, I mean, there's plenty of areas of crisis in the U.S. economy. The regional banking system desperately needs interest rates to be lower. One, because they're sitting on piles of U.S. treasuries with a much lower yield than today, so they need the Fed to intervene by dropping treasury rates. Also, they're sitting on a pile of devalued commercial real estate property or real estate loans backed up by properties that have lost a significant amount of their value because the mortgage rates on commercial real estate have gone up. And that the only way to fix that by the Fed is for them to slash rates and get mortgage rates lower to attract buyers to bid up the price of those assets. Now, the economy needs the Fed to cut. That doesn't mean that is the right move. I mean, what we really need is a recession. We haven't been allowed to have one, a real one, for more than a decade now. There's just been a papering over of these crises. But the problem is that now, because they've papered over the great financial crisis and the pandemic crisis and all of these problems, you've got all these inefficiencies in the economy. You've got a bunch of zombie businesses held together by easy money. You've got enormous onerous loads of debt that were taken on when yields were super low. So now when they rise, everything starts to show signs of collapse. And that's the point that we are at. And that is why I think from a technical standpoint, silver and gold are looking so good. I mean, all of these things coincide, right? And when the Fed begins printing, it's going to drive markets to new all-time highs, very likely. It is likely going to send gold and silver much higher. I think gold will lead, but ultimately silver will probably put on bigger gains because it's nowhere even near its all-time high, whereas gold is already, putting on new all-time highs. So silver has a way to go to catch up. But the inflation problem is going to be very significant. I know, we have an election coming up in November. I think that regardless of who wins that, based on the candidates that have been provided for us at this point by the system, there's no choice that's not going to result in higher inflation. And therefore, now is a good time, I think, to be getting into the assets that will benefit from that. Not financial advice, of course. I'm just giving you my thoughts on things and letting you know what I'm doing with my money and, getting some skin in the game. I'm not just, pontificating on this stuff. This is what I am actually doing myself. So anyway, let me know what you think in the comments down below about the situation we find ourselves in. Crusty White Bread in the chat says, the Fed is damned if it does and damned if it doesn't. And that's absolutely right. They have painted themselves into a corner. However, what we do know is that when faced with a decision between allowing a default or a collapse, an honest default on debt or versus devaluing the currency to pay the debt off in devalued currency, which is just a default by another name, typically governments and central banks will opt to go down the inflationary path. So while they are damned if they do and damned if they don't, I think that there's a strong precedent for them to follow the path of currency devaluation. But anyway, again, let me know what you think in the comments down below. Stay safe and happy stacking, everybody. I will catch you next time. Smart Silver Stacker, out.